Good morning or good afternoon, depending on where you are in the world. And here is a video looking at the difference between investing and gambling. Right, so what's brought this on? I am sure that you have all seen in the news the recent hysteria surrounding the blog site Reddit and then GameStop and what has happened to the share price of GameStop as a result of what was posted on the site Reddit. So what happened was essentially GameStop shares went absolutely through the roof and made a lot of people very rich in the process. But if you'd have bought into GameStop at that particular moment in time, would you have been gambling or would you have been investing? I think there are different things to consider when looking at it. As a little bit of background, what happened was somebody somewhere found out that a hedge fund, Melvin Capital, the one in question, was shorting GameStop. This means that they expected the price of GameStop to go down, and if it did, they would make a profit. So the way they do that is essentially they sell shares that they don't really own, and then they buy them back in the market at a cheaper rate once the option has expired. Slightly complicated, but that's basically how it works. If the share price goes down, those guys make a profit. What happened was somebody found out about this and bought it, told all their friends, posted it on the internet, and everyone bought it. And when roughly 7 million people get together and all buy it at the same time, the price goes up because the demand goes up. At that point, the option is about to expire, and then the hedge fund in question also have to then go and buy the stock, thus sending it up even further. And it went up a lot, from around about, I think it was about $18 at the start of January, up to, I think it did touch $500 per share at one point. So really big increases. So were these people investing or were they gambling? I'm going to break it down into 4 key areas to show the differences. We're going to look at time, we're going to look at knowledge, we're going to look at number 3, which is having a system, and we're going to look at number 4, which is emotion. Okay, number 1. Investors tend to be in it for the long term. If we look at a graph of the S&P 500, for example, we know that it's choppy in short bursts, but over time it tends to go up in value. The same could be said for an index such as the Global Developed Market MSCI, or even a really good mutual fund, or whatever the case may be. In short periods, they can be volatile, but over time, they tend to make a positive return, assuming dividends are reinvested, etc. So, time is very important. If you go to a casino or you bet on a horse race, the amount of time that you're in there can be very short. The winnings can be very big, and so can the losses, but the time period is short. We tend to see that investors are not really focused on short-term quick wins. They're looking to make really solid returns over time. Okay, number 2 was knowledge. The thing about GameStop is that when it was initially in the media, it was portrayed as this bunch of retail investors, i.e. novices, who didn't really know what they were doing, who were a bit anti-establishment and were taking down this big hedge fund, because the hedge fund lost billions in the process of this event. In fact, I mean, it's now come to light that a lot of the guys that made a lot of money off it weren't novices at all. Many of them had actually worked in the financial services industry prior to doing it. So knowledge is really important. If they knew what they were doing, they knew that if enough people jumped on board and they could get everyone in, that the price would go up. They also knew that GameStop would have that the hedge fund would have no choice but to buy back the shares that it had shorted, which again would fuel the price. Normal people don't know that kind of thing. Normal people don't know how short works or what happens behind the scenes or anything like that. These guys had knowledge, right? And if you're going into a position like that, armed with the knowledge on what you're doing and armed with the knowledge on what you expect the outcome to be, yet also armed with the knowledge of what the negative consequences of your action could be, then you're probably well positioned to make a decision. If you are just somebody who's doing it because your mate from the pub told you it was a good idea, or you read something online once, or you became Dr. Google, then you're probably not armed with the right level of knowledge to be making that decision. And at that point, you're probably more of a gambler than an investor. Okay, number 3, having a system. Long-term investors tend to have a system. The easiest example to think of, which most of us will have done at some point, is a basic pension fund or 401k or what a superannuation or whatever you want to call it. Okay, so as investors, which a lot of us are without even realising it sometimes, we would contribute on a monthly basis to that pension fund. Having a monthly contribution is a system. The system is called dollar cost averaging or pound cost averaging, because over time you would average out the volatility in that market by buying the average price over the window. That's the sort of maths, and that is a recognised, proven, useful system and an honest and great long-term way of investing, and it will work. Again, if you're just somebody who's ploughing in because somebody told you to, or you thought it was a good idea and you thought you'd make a quick win, you're probably then entering gambling territory, okay? And the 4th point, I think, is emotion. Investing's pretty boring, although I find it exciting. On the whole, it's quite dull. You're going to just put in an amount of money that's affordable every single month in the hope that with dividends reinvested and capital markets appreciating, over time you're going to make slow, steady, real returns, and you're going to get that annualised compounding growth on that money, so that in 15, 20, 25 years, whatever it is, you have made your money work hard for you and you can then do something with it. It is not that exciting. When I design portfolios, we try and do things with them to make it as exciting as possible, but the core of it, the bulk of it, is going to be focused on that long-term mentality. Casinos and horse racing and other types of gambling is quite fun, isn't it? It's quite adrenaline pumped and it gets you going and it's good to do. And I'm not saying don't do it. I'm not saying don't have fun. I'm not saying don't make stock markets about having a good time. But be armed with the right level of knowledge, have a plan, and be conscious of what you're doing, right? Understand what you're actually trying to achieve there. And try and make it as exciting as you can, but always have that fallback plan of investing being a little bit dull and it takes quite a long time. Don't fall into the trap of trying to hunt for those big wins in really short space of time, because then you are probably falling into the trap of gambling again. I hope that was useful. If there's something in there that you take away, then that would be really positive, because the more people that we can get towards an investing mindset and away from a gambling mindset, then the better, because it is possible to make really great long-term returns in markets, and having a sensible approach over time in a good system with the right knowledge, or at least someone like me guiding that knowledge for you, it will work. It doesn't work if you are making decisions with real money at real points in time for the wrong reasons, because what happens is you can then make real losses, and they can be quite big, and that big loss can happen quite quickly, and that's what we don't want to see, right? We don't want to see people doing that. So if that was useful, like, share, let me know your thoughts in the comments below, and have a great end to the week.